All right, let's get right to it. The S&P 500 is trading near all-time highs, but if you look under the hood, the data is telling a very different story, a story of extreme fragility, and it seems Wall Street's heaviest hitters are starting to agree.
Look, this isn't some random analyst's guess. This is a direct warning coming from the leadership at Goldman Sachs and Morgan Stanley. They're basically telling you that this calm we're seeing in the market, it's just an illusion. They're positioning for a double-digit correction.
So where are these cracks they're seeing? Let's dig into the specific data points that have them so concerned.
This number right here is at the heart of the problem, 11.8%. That is the current delinquency rate on commercial mortgage-backed securities for office space. It's a record high, and it's a crisis that has been building right in front of us.
Now, to put that into perspective, we have now blown past the peak delinquency rate we saw during the 2008 financial crisis. Let that sink in. This isn't just a red flag anymore, it's a full-blown siren. And that leads us to the most critical question for every single trader right now. Is this a contained problem in commercial real estate, or is this about to spill over into the entire financial system? Well, this stress in the credit markets is already bleeding over into investor sentiment. The AAII survey is showing extreme fear. Bears are now outnumbering bulls by 11 points. You know, we typically only see readings like this deep inside a bear market. And of course, a government shutdown that's now tying the longest on record isn't exactly helping things. This brings us to the next major warning sign. The market's internals are deteriorating. You've heard the saying, the generals are charging ahead, but the army simply isn't following them. This chart tells the entire story perfectly. You've got the market cap weighted S&P 500, SPY, being held up by just a handful of mega-cap names. But if you look at the equal weight version, RSP, it shows the average stock is already rolling over. This kind of divergence is a classic warning sign. And the advanced decline line confirms this weakness. For weeks now, we've seen more stocks falling than rising, even while the index itself stays elevated. This is textbook behavior for a top-heavy market that's getting ready to reverse.
Okay, so now let's turn to some of the leading indicators that are flashing red. When the most speculative assets start breaking down and the world's sharpest traders start placing bearish bets, it is absolutely time to pay attention.
First up, Bitcoin. It's now officially in a bear market, down more than 20% from its recent highs. Now, why should an equity trader care? Because historically, a breakdown in the most speculative parts of the market often acts as a leading indicator for a broader risk-off move in stocks. Next, let's look at Michael Burry's latest 13F filing. He's essentially making two big opposing bets. One, he's buying deep value in overlooked sectors. And two, he's actively shorting what he sees as the market's biggest bubbles. His put positions in names like NVDA and PLTR are a pretty clear signal that he thinks that the top is in for high flyers.
But, and this is a crucial point for anyone following these filings, this is rearview mirror data. These positions are from September 30th. It also doesn't give us the full picture of his options trades. We see the bearish bet, but we don't know the strike prices, the expirations, or the cost.
So with all this evidence pointing to a potential top, let's pivot to the key levels and the upcoming catalysts that are likely going to decide where we go from here. Here's what's on the calendar. We've got key economic data with the ISM Services PMI and consumer sentiment. On the earnings front, reports from Qualcomm and ARM will be pivotal. And then we have two major wild cards out of Washington, the November 21st government funding deadline and a Supreme Court decision on tariffs. It's a busy week.
This is it. This is the line in the sand, $674 on SPY. A sustained break below this critical support level would validate the entire bearish thesis and could absolutely trigger a much sharper, faster move to the downside. This content is for educational purposes only. It aggregates public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. And if you find this analysis helpful, please take a second to like and subscribe. It really does help the channel reach more people who are serious about the markets. Your support is greatly appreciated. Okay, let's put it all together. Here are the actionable scenarios and some potential setups to keep an eye on. Remember, this is about being prepared, not about being predictive.
So here are the two paths. The bear case is straightforward. Weak earnings and a decisive break of that $674 support on SPY. The bull case, on the other hand, really needs everything to go right. Strong earnings, some good news from DC, and a successful defense of that 674 level.
Now, for educational purposes only, here are some ways you could think about structuring a trade around these scenarios. A bearish thesis could be expressed with simple long puts or put debit spreads on SPY or the semiconductor ETF, SMH. If you're looking for a direct hedge against a market drop, long calls on a volatility product like UVXY could be considered. But I have to stress this. Options carry substantial risk. Losses can exceed your premium, so disciplined sizing and stop losses are absolutely critical.
So, with the big banks sounding the alarm, the market's internals clearly deteriorating, and a critical support level under pressure, the question you really have to ask yourself is this: are you prepared for this illusion of calm to finally shatter?
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.